No matter what side of the political aisle you're on, I think we can all agree that health insurance is confusing. And my controversial opinion is, I think they make it this way on purpose. Did you know that an estimated 80% of medical bills have some type of error in them? Now, I don't know if this is widespread incompetence or actual malicious intent. But either way, the only way to combat this is for you to become an expert.
But now you have been promoted. You are now one of my elite employees.
Aren't you excited? So what is health insurance and do you really need it? Let's really focus on that second question. So these are the complaints we hear all the time. Why am I going to pay for something if I'm never going to use it? Or why am I paying for something and then I have to pay even more when I do use it? And yes, that's the way it works. Nobody wants to have to use their health insurance. It's not like you're hoping you get sick to make it worth it, but it's there for you in case you need it. And that's why you pay to keep your health insurance active. And if you have health insurance, most preventative things are going to be covered, often with no copay. And you know what they say about an ounce of prevention. And health insurance is also there to protect you if you have major medical bills. That's when copays and coinsurance kick in, and of course there's that out-of-pocket maximum to prevent you from going into medical debt. We're going to talk about that later in the video. Now, if you want a plan with lower deductibles, copays, and coinsurance, or a lower out-of-pocket maximum, then it's probably going to have a higher monthly premium. It's far from perfect, but that's just sort of how it works. Additionally, people without health insurance are far less likely to go to the doctor for the little things, and those little things can very easily become very big, very serious, very scary, very expensive things that land you in the ER. Now, going back to premiums. Premiums, your monthly premiums, are what you pay on a monthly basis to keep your insurance active. Now, with some very few exceptions, such as short-term medical plans, under the ACA, which is the Affordable Care Act, you can't be charged more based on a pre-existing condition, and you certainly can't be denied based on a pre-existing condition. If you opt for a marketplace plan, you may be eligible for significant discounts via premium tax credits based on your income. On healthcare.gov, if you put in your zip code, it'll either take you to healthcare.gov or redirect you to your state's individual marketplace, and then it'll ask you a few simple questions to determine if you're eligible for a premium tax credit and estimate what that might be. So I highly recommend that you do click where it says start, tell you about, who's in your household. Let's put us and other people. Continue. We'll put married. I'm going to go through these as quickly as possible. Yes, we'll claim dependents. Let's say 2. Continue. Tell us about you. 35-year-old male who is a legal parent. Continue. And let's say our spouse is a 35-year-old female who is also a parent. Continue. And then let's say we've got 2 twin boys. Quite a lovely family. Okay, so this is our household. Confirm. Now we're going to estimate our income. So I want to show you this a couple different times so you see how that affects your premium tax credit. So let's say our total income is going to be $80,000. Your estimated premium tax credit is $1,104 per month. This is an estimate. Then if you were to view the plans, let's just skip this, what you will see is that premium tax credit applied and what your estimated monthly premium would be. I'm going to go back and I'm going to adjust the income that I put in. Let's put 70,000. I want to put 70,000 this time. This is why I wanted to look at this. You may be eligible for extra savings if you pick a silver plan. If this pops up for you, that you may be eligible for extra savings with the silver plan, please, please, please look at the silver plans very closely, because with these extra cost savings on deductibles, copays, and coinsurance, it very often works out that a silver plan is actually going to be a better deal for you than even a platinum plan when you actually utilize your health insurance. So take a look at that, and then we can actually sort by silver, apply filters. And you'll see you'll still have some pretty reasonably priced for a family plan, silver plans, that will offer you tremendous cost savings with those extra cost savings offered by silver plans. Now, of course, if you wanted to skip these questions or you made significantly more money, then you would see full-priced plans, which are going to be a lot more than what we were looking at before. Then there are, of course, those additional costs that we talked about earlier in the video. First, there is the deductible. The deductible is the amount that you have to meet out of pocket before your insurance begins to contribute to the cost share. So you would have to pay the full price until you hit your deductible. Now, many services are actually covered even prior to meeting the deductible, and there are many that are offered with no copay whatsoever, like your basic wellness, preventative visits, and vaccines. Additionally, with a deductible, if you have a family plan, you need to understand the difference between a family deductible and an individual deductible. So if you, as an individual on a family plan, have met your deductible, then you're good to go. Your insurance is going to charge you copays and coinsurance from here on out. However, if your family has met the family deductible because they're keeping track of how much you're spending, even if you yourself haven't met your individual deductible, then still your insurance is going to kick in and you'll be responsible for copays or coinsurance as opposed to having to pay the full amount out of pocket until you meet that deductible. Really, it's designed to help you if you're on a family plan. Now, when I say cost share, what I mean is copay or coinsurance. A copay is a fixed amount. So for example, it might cost you $25 to see your doctor, $50 to go to an urgent care, and $450 to go to the emergency room. And it could be more if you're going out of network if you're on a PPO. Again, more on that later in the video. Then there's coinsurance, which is a variable amount. As opposed to a fixed amount, you're now going to pay a percentage of the cost. So you might pay 20% for a specific service or treatment. You can understand why coinsurance is a little bit more difficult to understand because you know what your copay is going in, but you may not know exactly what you're going to be responsible for if you don't know what the total cost is, because you're going to pay 20% or whatever your coinsurance is. Then there is the out-of-pocket maximum. This is there to protect you from major medical debt and major medical bills. Basically, it is the financial threshold. Your health insurance plan is keeping track of your spending. And if you reach your out-of-pocket maximum, which could be a couple of $1,000s, maybe more depending upon the type of plan that you have, if you reach that financial threshold, then your insurance plan is going to take on the remainder of the bills for all of those covered in-network charges for the remainder of the calendar year. And the same way it works with the individual deductible versus the family deductible, the same thing applies with an individual out-of-pocket maximum versus a family out-of-pocket maximum. So even if you haven't met your out-of-pocket maximum, and we hope you don't, but a family member or multiple family members have major medical needs and you've met the family out-of-pocket maximum, then the rest of your bills are going to be covered for the remainder of the calendar year as well. The three basic types of plans are HMOs, PPOs, and EPOs, and they're all, of course, a little different. So HMOs are on one end of the spectrum, PPOs are on the other, and EPOs are somewhere in between. With an HMO and with an EPO, you will only have in-network coverage. With a PPO, you have coverage in and out of network. Now, the exception to this in-network coverage only rule for HMOs and PPOs is in the case of a true medical emergency. For an HMO, you do need to have a PCP, which is a primary care physician. That's not the case with a PPO. With an HMO, you need a referral to see a specialist. That is not the case with a PPO or an EPO. Then HMOs usually have lower monthly premiums. PPOs usually have higher, with EPOs somewhere in the middle. EPOs are really most common on the marketplace. You don't necessarily see them as much in private insurance. More acronyms to throw at you: HDHP and HSA. HDHP is a high deductible health plan. It's just a type of health insurance plan that has a higher deductible. Sometimes HDHPs will offer HSAs, which are health savings accounts, as a benefit. And these are very popular with the FIRE community, more acronyms, Financial Independence Retire Early. So as I said, a high deductible health plan, or HDHP, is just that, a plan with a higher deductible. However, as I mentioned earlier, many services will be covered even prior to meeting your deductible. And very often plans with higher deductibles have lower monthly premiums, which means this can be a great way to save money if you're someone with lower medical needs, or someone with extremely extensive medical needs who's sure to meet that deductible very quickly. And then there's that HSA, health savings account benefit, that may be available with an HDHP. And these health savings accounts are only available with HDHPs, but not all HDHPs offer HSAs. So an HSA is a separate account with your money in it. You contribute however much you want up to the maximum set by the IRS that year. And the amount that you contribute is pre-tax, therefore lowering your taxable income. Now, as long as you withdraw from your HSA for a qualified medical expense, and the list is really, really long. I mean, it even includes like Advil and chiropractic care. As long as you withdraw for a qualified medical expense, then there is no penalty or taxation. These accounts are interest-bearing, and the interest accrued on the account is also not taxed. And if you're looking to use it as a wealth-building tool, you can actually invest a certain portion of your HSA, and the earnings on those investments are not taxed. And this is why it's known as having the triple tax advantage. Now, you can hold on to that HSA year over year and let the money roll over, unless of course you're withdrawing all of it for a qualified medical expense, but you can continue to hold on to it. And if you do, and you hold on to it until you're 65, then you can convert it to a basic retirement account. And there are other options as well. There are short-term medical plans, which is a type of private insurance. Now, because these are private insurance, short-term medical plans actually aren't beholden to the same terms under the ACA. So that means you may be subject to medical underwriting, you could be charged more. If you have a pre-existing condition, then it certainly won't be covered in the first year. And unfortunately, as of September 2024, there aren't going to be multi-year plans anymore. You'll really only be able to get a plan for a period of up to 3 or 4 months. So from that point on, they're really just going to be meant as a stopgap, but it can be a good stopgap to provide you with nationwide PPO coverage and a plan that could be less expensive based on your medical history. Speaking of stopgaps, there's COBRA, which may be offered to you by your employer if your employer offers health insurance to its employees and you are no longer with your employer. Then again, there is COBRA, which is definitely meant as a stopgap because it is very expensive. You can expect that your premium will at least double what you are currently paying, but it will allow you to keep the exact same coverage that you have through your employer. Then there are catastrophic coverage plans. Sometimes people refer to short-term medical plans as catastrophic coverage plans, but they're not really the same. Catastrophic coverage plans are just that. They will have very low monthly premiums, and they will usually have very high deductibles, high out-of-pocket maximums. They're just there to protect you should the worst happen. You get cancer, you fall off a building and break every bone in your body. Well, at least you're going to have something in place that didn't cost you a whole lot on a monthly basis. These are available on and off the marketplace. And then there are other things like DPC, which is direct primary care. That's an agreement that you can enter into with your doctor if they offer it. Not a lot do. It's not really insurance, but it'll give you direct access to your doctor. If you do enter into such an agreement, then you're definitely going to want some type of catastrophic coverage plan as well, because DPC, direct primary care agreements, aren't going to offer you any type of hospital benefit. And then there's health sharing ministries.
Health sharing ministries.
Oh, please watch our video about health sharing ministries. We do not recommend these at all. They're very vague as far as the legality of it. Many people aren't able to get reimbursed. You have to pay out of pocket and then expect to be reimbursed. They're really just a bad situation, and tons of people report being unable to be reimbursed by them. So make sure to check out this video to learn more. If you want to learn more about health insurance in general, then make sure to check out this playlist. If you have questions, you can reach us in the comments or at the number on the screen. There is absolutely no charge for our services. As always, please make sure to like and subscribe, and we'll see you next time.